Hi, welcome to Shard's Outlook on what's going on the global economy and global markets. Here we are at the end of February and things are looking very interesting. In the last few days, we've seen Trump declare that he will extend the deadline on Chinese tariffs and that they are very close to a deal. That's kind of got the market rather surprised. We did think it was going to take some time before the Chinese and Americans would actually sit down. And what we've seen though is Trump doing what we now expect Trump to do. First of all, he threatens enormous tariffs, tells everyone what a brilliant trade negotiator he is, and then when it comes down to the wire, he doesn't pull the trigger. And the kind of deal we're expecting now with China is likely to be one that both sides can walk away and claim some kind of victory. It won't really change very much, but what it does do is remove many of the threats that have been overhanging the global markets. The idea that drying up trade between China, the US and the rest of the world as a result would cause trade to contract has been removed, and we do expect to see expectations and sentiment recover. And this is one of the reasons that we think this year may prove to be more surprising to the upside than we did think. If you remember, in December, we saw stock markets slide dramatically. We also saw the bond markets suddenly close down on illiquidity, with the high yield markets closing quite dramatically. Since then, we've seen stock markets recover strongly, and many analysts are now predicting they are back on course to recover the highs that they made towards the end of last year. And the bond market is open once again. We're seeing some of the more riskier names being able to fund themselves quite aggressively. Even countries where we know there are serious issues to be addressed, such as Italy, have been able to fund themselves without any major blockage in the market. So markets are looking much stronger. And now that we have this apparent accommodation with the Chinese, maybe there are reasons to expect global growth to continue strong. Now, many economists do expect that after 10 years of steady but slow growth since the global financial crisis in 2008, at some stage the global economy is going to have to take a breather. We think that's probably right. Sometime later this year or maybe next year, you will see a natural slowing down as the economy picks up. By that I mean in the States, we already have full employment. And when you get to full employment, you eventually get to a situation where there just aren't the marginal workers able to step in. That isn't the case in Europe, where we've seen a very substantial economic slide in recent weeks, perhaps triggered by the lack of sentiment stability over the things like a trade war with America, but also concerns such as Brexit. We now find ourselves at a very interesting stage. Which way do markets go from here? And I think there's really two paths that we can look at. The first is that the removal of a lot of the Trump-driven trade tariff war fears is going to cause the global economy to continue on track for longer. We're also going to see low interest rates. The Federal Reserve has made that very clear in the States. The ECB has no choice but to keep interest rates low. And recently we've seen the Chinese central bank aggressively supporting the Chinese market. So a continuation of global growth, a continuation of low interest rates, and perhaps the global economy is going to remain in boom mode. That would certainly be an upside surprise for everyone that's been predicting recession later this year. On the other hand, though, we need to balance that with the other side of the equation. And there still is a lot of uncertainty out there. Even after solving the China trade dispute, there is still the next trade dispute that Trump is determined to have, and that will be with Europe, primarily over German car exports. That still has the capacity to cause serious structural and sentiment damage across Europe, where, as I've said, we already have a mini recession underway. There is then also the political aspect. In Europe later this year, in May, we have European elections, which are likely to elect populist governments, either right-wing or left-wing leaning. The right-wing are going to take their support from Europeans scared of immigration, whereas the left-wing will be addressing all the standard left-wing clauses. We're even beginning to see that happen in the US, where it is clear that the 2020 election campaign is already underway, with a number of Democrats already pinning their hopes to socialist-led policies such as Bernie Sanders. It is going to be very interesting in terms of just how destabilizing politics may be. And then, of course, in the UK, in less than 30 days' time, we have the Brexit date, and yet no agreement. Personally, I suspect Brexit will prove less destabilizing to markets than many expect if it occurs in the worst case. But until then, we still have an opportunity that a solution may be found, a deal may be inked, or perhaps we'll see an extension. Who knows? I suspect Brexit just continues to drag on and on and on, and will continue to pull down the UK market. But what is interesting, despite the uncertainty of Brexit, the UK economy is still doing relatively well.